Nilesh Shah joins us now. Let's take a conversation forward. We haven't interacted with Nilesh Bhai in a while, so always fantastic to have him back. The smile on your face, Nilesh Bhai, is telling me that you are not heartbroken after Argentina's defeat.
Nikunj bhai, I am a cricket fan. I know very little about football.
You know, after
And
what
may the
happened at
best
the
team
World
win.
Cup, what happened at the World Cup, I thought I might as well change the sport only. And here I changed my preference from cricket to football, and Argentina loses. So back to tracking markets, Nilesh Bhai, which is what you and me should do. Now, my question, Nilesh Bhai, is at the current juncture, looking at where we are, where inflation concerns are getting doused, where markets are reconciling to the fact that commodity prices are down, global markets are looking much more stable. Are we in for a good patch for next couple of months?
Uh, Nikunj bhai, market has discounted most of the positives, which you mentioned. India growth ahead of global growth, commodity prices, including oil, softening, inflation coming under control in India from Jan 23 onwards, and globally also central banks kind of slowing down their rate hikes and more capital flows into India. So, in some sense, we are like Argentina against the Saudi Arabia match, where with players like Lionel Messi, there was expectations that they will dominate and win the match. Markets are discounting most of the positives, and hence it is important that we deliver. We don't run on reputation, we run on actual performance.
How would you define actual performance then? Nilesh bhai, what is the definition of actual performance? I mean, from a stock market standpoint, will it be the macro? Will it be the earnings growth? Will it be the trajectory of how banks are moving? So, what are the yardsticks which you would use to judge the real actual performance?
So, Nikunj bhai, a very surprising fact is that in the September 22 quarterly result for Nifty 500 companies, EBITDA margins have actually come down sharply. They are lower than even June 20 quarter. Now, because sales is 2.25 times higher than June 20 quarter, absolute EBITDA as well as absolute net profit after tax is higher than June 20 quarter. But the EBITDA percentage reduction does show that companies don't have pricing power, or the raw material cost increases they have not been able to pass to the consumer. Now, clearly, we need EBITDA margin to expand or sales value to expand at a much faster pace. Maybe September 22 quarter was an aberration. December 22, thanks to the festival season, could see uptick in EBITDA margin. So at the end of the day, market will be looking forward to the profitability and earnings. Undoubtedly, our governance as well as commitment to green both will be counted, and that will give us a premium to other emerging markets. But the biggest driver for return from here onwards will be earnings growth.
Is that the reason that, Nilesh, morning, firstly, that, there's a lot of thrust towards the FMCG stroke consumer space? Is there an optimism when it comes to earnings revival within FMCG?
I think in FMCG, apart from earnings growth, there is also realization that these are the stocks, but there is no issuance. It's easy to get out of some of those FMCG stocks, but very, very difficult to get in. Over last year or so, people have realized that. And hence the sellers are reluctant. They are happy to absorb 1 or 2 quarters of underperformance because the long-term story remains always better. So my feeling is that it is the lack of selling which has ensured that the FMCG stocks continue to trade at a higher valuation. And apart from that, obviously, there is long-term growth story that eventually India will move towards lower middle income country and middle income country, boosting consumption.
Yes, and there have been recent buys by Kotak AMC in the likes of Dabur, ITC, as well as HUL. But of course, given the fact that IT as well has been of quite a bit of interest of late, do you think that now with valuations turning a lot more compelling for the IT sector, that this is definitely a space that investors need to park their money?
Definitely, this is time to start accumulating IT stocks. They have some headwinds still coming in terms of demand uncertainty. However, some of the pressure in terms of salaries and wages cost has started reducing substantially. Valuations have corrected quite significantly. And more importantly, these are the most cleanest of balance sheet with one of the best governance. I believe as Nasdaq starts bottoming out and moving up, there will be rub-off effect on Indian IT companies. So we will be looking to accumulate IT stocks on a bottom-up basis over next 3 to 6 months.
Okay, so you're looking to accumulate IT over the next couple of months as valuations continue to correct, a phenomenon that started in the US. Good morning, this is Nentara also joining in. Can I ask you, as we go towards the year end and the new year will also begin, going back just to the basics, because we're so close to that all-time high as well, but there's some zing seems to be missing. How do you anticipate the year ending for India? And next year, do you think India is going to stay as the outperformer, given all the kind of noise we started to see here from China?
So next year will be fight between flows and fundamentals. Undoubtedly, India's weight in emerging market has moved from about 8% to 16%. That will probably go up higher as HDFC Bank enters into MSCI emerging market. It can go even further higher if Korea gets upgraded from emerging market to developed market. There is also a trend where many investors are looking for MSCI emerging market ex-China indices. If that trend picks up, there could be more flows to India. The domestic institutional investor flows also continue. So clearly on one side, we believe next year FPI as well as domestic institutional investors will be net buyers in the market. On the other hand is the earnings growth trajectory. We are at a stage in valuation where we trade at a marginal premium to our long-term averages. However, we trade at a substantial premium to other emerging markets. It's not that our valuation has expanded by much, but their valuations have corrected significantly. Now, if my earnings growth delivers better than my peer group, then certainly those premium can be justified. And then fundamentals and flow ensure that India is an outperformer. However, if September 22 quarterly results trend continue, where earnings growth is subdued, muted, then there will be a fight between fundamental and flows, and India may not be an outperformer. It will be suffice to say earnings growth next year will determine whether India is an outperformer, market performer, or underperformer.
Okay, so too early to call it as yet. You, of course, mentioned the elephant HDFC, which has started to dance, conversation we've been having over here. And with that, Nilesh, I'd like to talk to you about another big theme that has been playing out in the markets. Of course, you've seen those returns from SBI since the outbreak of the COVID-19, returns that investors were not used to from SBI. It's been followed up from the likes of ICICI. HDFC started to perk up. But the action you're seeing in the mid-tier banks, Bank of India, Union Bank, Canara Bank, the question is, how are you all looking at it? And is that a story that is also going to be sustainable?
So we believe some of the large cap banks, including PSU and private, are more of a compounder over a longer period basis. There is business consolidation happening. There is increase in margin thanks to rising interest rates. And there is also a Cinderella time going on where NPS are unbelievably low. However, the smaller and mid-sized banks which have seen far more return. That's probably a correction from an extremely cheap valuation to reasonable valuation in a very, very conducive environment. Going forward, we believe it will be difficult for small and mid-sized banks to continue that kind of performance. From a portfolio point of view, we prefer larger banks over small to mid-sized banks.
Nilesh bhai, the theme this year was inflation. Next year, it could be recession. If the underlying template of the market, which was centered around fear of a rate hike, next year could be centered around demand. If the template changes, what happens to the market positioning? What happens to risk? What happens to sectors? Because there are sectors which do well when there is inflation fear. There are sectors which tend to outperform when there is a recession fear.
So Nikunj bhai, the million-dollar question is whether inflation will be sticky or not. The historical experience does suggest that inflation is normally sticky. It is function of money printing. And while central bankers around the world have raised interest rates, they haven't withdrawn liquidity as much as they were supposed to withdraw in order to control inflation. Now, there is one class which is saying that with the growth slowing down and there is a lag effect on interest rate hike, we will eventually see inflation coming down sharply. Markets in US today are discounting rate hikes till mid-23 and rate cuts in the second half of 23. There is also precedence which shows how Bank of Japan, once it played with pumping liquidity and cutting interest rates to support economy, over 30 years has not been able to come out of that journey. They are like, the old serial of Star Trek, boldly going where no man has gone before. They have been buying equity and they have emerged as the largest equity holder of Japanese equity in the world. We believe, in our opinion, low interest rates and high liquidity is like drug, easy to get in, very, very difficult to get out. And today, I don't think so there is political consensus to give pain to the Western world, to give pain to the Western civilization by virtue of tight liquidity and high interest rates. Moment they see inflation coming under control, most of the Western banks will follow Bank of Japan model of pumping liquidity and cutting interest rates. And hence, I say next year will be a fight between fund flow versus fundamental.
So which side would you endorse? The technical part, which is funds, or the fundamental part, which is earning and valuations?
Nikunj bhai, very, very tough question. We generally follow the fundamental side because funds can turn overnight. Fundamentals take time to turn. Fundamentals are like oil tanker, move slowly, but they can withstand the storm. Flows are like speedboat, moves very, very fast. But when the storm hits, I better be in oil tanker than in speedboat.
Nilesh Shah, it's always great talking to you. Thank you so much for joining us today on the channel and being so candid with your views and whether this outperformance can continue or not. You can make out you're not ready to say it yet that the outperformance will be there in 2023. Thanks a lot for being live with us today.